morning everyone and welcome to our 2020 results presentation. One of the many challenges that COVID has thrown at us is not being able to present these results to you in person. We're therefore using the video format for the slides, and then Stuart, Paul and I will be hosting a conference call at 9 AM today to answer any questions. If you don't already have the dial-in details for that call, they're available from Tulkan. You will have seen our recent announcement about my upcoming retirement at the end of the financial year. You'll be pleased to hear that I'm not going just yet and will be around for our interim results in December. But after Stuart has been through the financial results for FY20, I'll ask Paul to take you through Studio's trading, both for FY20 and more importantly, and what really excites me, is what we've been able to achieve since the start of lockdown at the end of March. FY20 seems like a lifetime ago, but it was a year of change and transition for the group. Studio once again performed really strongly during its peak trading period ahead of Christmas, but difficult market conditions for retailers even then, and Brexit-related uncertainties made it tougher going at other times. So whilst 2.5% product revenue growth for Studio and an 8.6% growth in adjusted PBT for the total group was respectable, we were a little disappointed. Core net debt came down by another 6 million during the year, and we've seen further improvements in lockdown, which Stuart will cover in his presentation. We also continue to expect a bigger reduction in net debt when the sale of education to IPO is cleared by the Competition and Markets Authority later this year. We've talked a lot over the last few years about the three pillars and our investment in modernising Studio and improving its digital capabilities. And to that has put us in a strong position to handle the effects of lockdown. Studio was already in a digital sweet spot for retail with its value proposition and online capabilities. But I didn't expect during the past 20 weeks to see 42% growth in product sales. I'm really delighted with this performance to date and with our colleagues' response to the challenges of COVID. Paul will talk more about that later. But it's important to stress that Studio's peak trading period is still ahead of us, and market conditions are likely to get tougher. So we'll know more about the balance of the year in a couple of months' time. With that, I'll hand over to Stuart, who can describe last year's numbers in more detail.
Thank you, Phil, and good morning, everyone. As Phil mentioned, this has been a transitionary year for the group with the sale of education. And as well as needing to account differently for education, we also have the new accounting standard for leases, along with some new challenges with COVID in showing our bad debt charges. So, as we did with our interim results in December, and in keeping with how both the research analysts and us as a management team have monitored the group's financial performance during FY20, we've primarily focused today on a constant gap combined group set of numbers to aid comparability. Total group revenue for the year grew by 2.2%, with Studio up 3.1% and education down slightly by 2.6%, primarily due to the closure of schools in February and March. Without that, education seemed on course to deliver a broadly flat revenue performance for the year. The like-for-like adjusted profit for the total group grew by 3.9% to just under £40 million. And the headline PBT grew by 8.6% to £31.2 million. And core net debt, as Phil said, fell by £5.6 million to £51.8 million. Here are those like-for-like profit numbers set out by division. I'll talk more about Studio in a moment. Central costs were lower than prior year, in part due to management bonuses not being paid in respect of FY20, along with lower FX translation costs. I mentioned at the interims that we received a refund of around £0.6 million from one of our bankers who'd overcharged us in the past, which is the main reason behind the interest charges being lower at £8.7 million. Here's Studio's income statement on that like-for-like basis. We noted in December that Studio's revenue was flat in H1 with the margin rate having gone forwards. And as we moved into peak last year, our sales grew much more strongly, albeit into more competitive pricing conditions. And then as we moved into the aftermath of Christmas and on into Q4, the retail market really started to become more challenging. And so in that context, our retail sales growth of just 2.5% for the full year, compared to the 8 to 9% that we've seen in the 2 previous years, was a little disappointing. But notwithstanding that, gross profit from our retail activities moved forwards. And we made some good progress with modernising our retail systems, as Paul will talk about shortly. Our financial services performance was more consistent, with revenue up by 4.9% and a steady improvement in the underlying arrears performance and good recovery rates from selling our debt to third parties. Those improved a little. So our underlying FS gross profit improved by 5.8% to 85.6 million, which really underlines the attraction for Studio of having this second revenue stream. Marketing costs across the year were flat, with distribution costs increasing in line with the product sales. Our administration costs and depreciation, they increased at a little higher due to our continued investment in strengthening the business's digital foundations for the future. So overall for Studio, its operating profit slipped back slightly to 39.0 million on a like-for-like basis. Now, I mentioned the various presentational complexities and adjustments with this year's accounts. So here is a bridge between that headline profit of 31.2 million and the reported profit of 8.8 million, and I'll take these in sequence. Firstly, the introduction of IFRS 16 for leases, it brings in a series of changes to both the presentation and the timing of recognising the costs of our various warehouse and office leases. As you know, there are some choices within the accounting standard, and we have used the modified retrospective approach, which means that we don't go back and change last year's numbers. There are tables within this morning's press release that will show you how the detailed numbers and the mapping have been affected by this change. Having announced the conditional sale of education with the interims and designated it at that time as a held-for-sale discontinued operation, then technically, per IFRS 5, we shouldn't continue to depreciate its fixed asset base beyond H1. For internal comparability, we did continue to charge that in H2, but in the reported numbers, we need to increase the profit by reversing out that 1.4 million of H2 charge. We noted during the year that, in common with other legacy lenders, we'd seen an increase in PPI claims back in August ahead of the FCA's deadline. We told you at the half-year point that an additional charge of 7.9 million was required, but now that we've finished that exercise and reviewed the claims, we've actually only needed to book 5.6 million for that. So on top of the education sale costs and an impairment to site costs associated with that we booked at the interims, that brings the exceptional charges for the year to a total of 8.3 million. Now, you've seen from our 2 trading updates that we've issued since March that we're anticipating a significant rise in unemployment and potential hardship for our customers later in the year when the government furlough schemes and other fiscal incentives start to fade away. IFRS 9, which looks at bad debt provisioning, it requires us to use the external economic forecasts available at March 20, so at the very start of lockdown, to estimate what the future losses in the coming 12 months or so will look like. And given how uncertain things were at that time, and given that we've yet to see any real crystallisation of those anticipated losses, the job of estimating and booking a charge into these accounts has been really challenging. But at the same time, we've also updated some of the data sets that feed into our provisioning model, using more relevant data, which essentially tells us that our model has been overestimating our potential losses a little for a while. And the net of those 2 factors means that we've lifted the bad debt charge and the bad debt provision by around £16 million in total, compared to the like-for-like numbers that we showed earlier. Now, based on the information we have in front of us today, and given that arrears remain in a very healthy state today, that estimate seems to be towards the top end of what we actually might expect to see crystallising later this year or maybe early next year. So it is just an estimate. and we'll keep you informed on how the real data maps out in future statements. Finally, and as we've done for several years, we've separated out the fair value movement on the FX hedging contracts that we've taken for FY21. Our policy is to cover for rolling 12 months, and the average rate of cover for FY21 is $1.30.1 and covers around 82.5 million of contracts. Now, liquidity is the key tool for all businesses at the moment. And given that at the start of the pandemic and our initial response and actions straddled the year end, it's quite difficult to read much into the actual net debt figure as at the 27th of March, which was £51.8 million. There were a number of timing differences across the year end. Firstly, the pre-planned stock intake that we accelerated in February versus the equivalent timing in 2019. But then, as we've said, we applied the brakes on creditor payments very abruptly once lockdown was announced, until we had a clearer understanding of where we were with Studio's operations. So the takeaways today on debt are as follows. Firstly, we've extended the term of our debt out to the end of 2021, and we'll revisit that with a longer term refinancing once education is sold. Secondly, the quality of the Studio receivables continues to improve, as I mentioned, and that means that more of the receivables are eligible to be funded by the securitisation facility, and that advance rate against the receivables has actually increased a little during the year. Our CapEx in FY20 was around £15 million, so that's a little higher than we saw in FY19. And depending on how the rest of FY21 goes from both a trading perspective and from a bad debt perspective, it's likely to be a little higher again this year as we continue to invest for the future. Finally, and most importantly, our current liquidity position is very strong due to the exceptional trading performance of Studio in recent weeks. The position, as at last Friday, showed our core net debt position at just £35 million, and that compares to near £75 million, 40 million higher, at the same point in 2019. Now, we know that bad debt cash loss will emerge eventually, so we remain very cautious. But this is a really healthy position for us to be going into our peak trading season with. And finally, I've mentioned IFRS 16 a few times now. It makes a huge difference to what's technically regarded as debt, as you'll see here. And we think it will take some time for the new norms to be established in the marketplace on gearing. And in the meantime, we'll continue to comment on what we've regarded as net debt in the past. A few words now on some of the other items on the balance sheet. Firstly, the legacy defined benefit pension scheme, it's had a very good year. We've yet to finalise the formal triennial valuation for April 19, given the interplay with education sale. But the IAS 19 version of the valuation at March 20 has increased very significantly to just under £32 million. Now, that was perhaps a slightly helpful point to measure it at, given that bond spreads widened materially at the start of the lockdown period. But the trustees also helped the position by de-risking the asset portfolio by exiting from equities in mid-February, whilst retaining a useful level of hedging in the portfolio. We've continued to put £5 million into the scheme, and will continue to do that for now until the education sale completes. The tax charge for the year from continuing operations is actually a credit of £0.2 million, and that was helped by favourable treatment for the various adjusting items that I've described, as well as revaluing the deferred tax asset that associates with the pension surplus from 35% to 19%. Paul will talk to you in a minute about the group's response to COVID, but I should mention that we did use HMRC's option to defer our PAYE and NI duties and also our bonded warehouse payments at the very start of lockdown. But we have since fully repaid all of these cash deferrals. Finally, a few words about education. And firstly, a reminder of the headlines of the sale agreement that we announced in December, which is a headline price of £50 million, representing 10.3 times education's FY19 EBITDA. And we're currently working with the buyer, YPO, to get clearance for the sale from the CMA, who are currently in the midst of their Phase 2 market study. Their website says that they should reach a final decision in mid-December, and naturally we'll provide updates as and when we can. we agreed to put a lump sum contribution of £13 million into the pension scheme out of those proceeds. So post-deal costs, we're expecting net proceeds of around £35 million. In terms of how education performed during FY20, it was essentially a case of a very solid performance being tainted at the very end of the year by schools closing, first internationally in February and then in the UK in March. And it's very difficult to put a precise figure on what we might have sold in those final weeks if COVID hadn't happened, but an estimate of somewhere between £700,000 and £1 million of lost profit wouldn't be far out. Since the start of the new financial year, we've needed to take a much more cautious approach with this business due to the schools being closed. But over the last few weeks, we've certainly seen ordering levels return to their normal patterns, and we're hopeful of full normality returning when the schools reopen in a couple of weeks' time. And certainly the signs from Scottish schools, which reopened last week, have been very encouraging. With that, I'll hand you over to Paul, who'll talk to you about how Studio's fared.
Thanks, Stuart, and good morning, everyone. Over the last couple of years, we've implemented a number of changes at Studio that have helped us not just survive the COVID-19 crisis, but to grasp the opportunity as customer behaviours changed. Our customer base fell 2% in FY20, as we had a number of changes that were required on how we accept credit customers, reduce new customer acquisition. In this year, however, we've seen a step up, significantly aided by the changes we made to allow customers to pay by cash at the point of sale, and enhanced promotion of the credit account benefits. To date, we've seen customers this year, now over 2 million, up 11% on last year, and new customers are up by more than 140%. Continuing to build the customer base will be a focus for the remainder of this year, and it's key to giving us a strong platform for future growth. Spend per customer last year increased by 7% as we started to deliver more personalised offers through use of Salesforce Marketing Cloud and developments to our product ranges and credit offers. This year we've seen sales per customer increase yet again, and the improvements made to our credit account application process are seeing especially encouraging increases for new orders. Our strategy for the last few years has been to transform to an online retail business. Last year we increased online ordering to 84%, up 9 points on the prior year. With lockdown we had to close our telephone order lines and cut back on catalogue mailings, so this online transition has been vital in the success we have seen over recent months. We launched the Studio app in 2019 and have seen high levels of download and usage, with customers using it as an order channel and also a convenient way to manage their account. Studio has seen strong sales growth through lockdown, and this has continued despite the high street reopening. Total product sales for the first 20 weeks of the year are up 42%, which has been driven by our home and leisure ranges, with very strong performance in electricals and home. The market has seen clothing and footwear in decline as customers didn't spend on their wardrobe when they were stuck at home. We recognised this early, so took swift action to clear the spring-summer ranges. And although this had some impact on margin, we've seen sales growth and our stock position is healthy. And we're now launching our autumn ranges with great value core lines and discounted brands. These are a selection of our winning lines so far this year. As you can see, we've sold over 1 million of garden equipment from just 2 products. And our ranges appealed strongly to those working from home and just staying at home trends. And as you can also see here, we were able to drive significant volume from these lines and across our own brand and branded products. Further developments for Christmas include a new range with Lego. As the COVID crisis developed, we've acted quickly to ensure we looked after our colleagues and customers and that we as a business survive. We rolled out additional laptops and remote working technologies so the bulk of our head office colleagues could be based from home. This created space so we could create a safe working environment for those who had to remain on site, and a number of measures implemented to enhance protection against the virus. We had around 100 colleagues deemed as high risk, who were in roles who could not feasibly work from home. Even before lockdown, we asked these to remain at home and on full pay. We're not looking to take any government support for furlough or government-backed loans to support Studio given our trading performance. We also implemented action to support customers. In line with FCA guidelines, we provided 25,000 customers so far with the payment freeze, and many of these are now back to normal arrangements and up to date. Overall payment rates are encouraging, but as Stuart has explained, we provided for bad debts that may arise as the recession starts to impact customers' income. At the start of the crisis, it was uncertain if Studio could remain open, and we drew up plans to protect cash. However, as we've continued to trade and have been able to create a strong cash position, our focus has shifted to investing in the business to create a platform for future growth. We've increased marketing activity to attract new customers looking for value and are now looking to accelerate a number of our digital transformation initiatives, such as data capabilities, so we're in a position to further develop Studio and enhance longer-term profit growth. We've also had a number of initiatives to support the NHS and our local communities, so we give something back to those that need a little bit of extra help in these tough times. Over the last few years, we've progressed a strategy to change Studio from a catalogue-centric business to a pure play online value retailer. And with the vast majority of orders now online, this has been achieved. The next phase of our evolution is to become fully enabled digital retail business, using data and technology to improve decisioning and customer engagement in all aspects of the business. Within retail, we will focus on increasing our customer appeal through our unbelievable value offer. By raising awareness of Studio with targeted marketing activity, we'll acquire increasing numbers of new customers and offer them an improved experience to aid retention. We will continue to develop our website and app, with new functionality implemented to enhance the customer journey. Through ongoing development of our product ranges, we will provide customers a broad range of own brand and branded products. This again is being informed by data, using insight on performance of different categories to determine its role within the range. This can then drive greater intelligence around pricing decisions, and through enhanced merchandising tools, we will improve margin. Within financial services, the ability to offer flexible payment options has never been more relevant. We continue to develop the proposition and have implemented new systems in this area to better manage accounts and enhance credit decisioning by understanding what customers can afford so that we lend responsibly. We know that customers who have an account not only provide Studio with an additional revenue stream in financial income, but it also drives customer loyalty and is a driver in maximising lifetime value. To enable both our retail and financial services opportunities, we need to have the strong foundations of the business in place. This includes investment in data capabilities, creating a modern and agile IT architecture, and having people with the right skills in an environment in which they can flourish. We are also looking at warehouse plans that continue to support Studio's growth ambitions, be efficient, and offer enhanced delivery options for customers. Our performance during COVID-19 has given us confidence to accelerate many of our future plans, while also recalibrating some of our focus. Customers have reacted strongly to our online value offer, and we're keen to drive further awareness and consideration for the Studio brand, with increased investments to grow our customer base for future success. Including partnering with ITV's I'm a Celebrity, Get Me Out of Here, scaling up our TV and digital ad spend, and keeping our investment in catalogues, which are proving a welcome alternative as customers experience device fatigue through lockdown. Our app has emerged as an attractive channel for our customers to both manage their credit accounts and also shop our fantastic range of value products. So we've created a dedicated squad to accelerate its development and make it the way to manage your Studio account and shop with us. We've invested in data science incubator to run huge-scale analytics to help inform our media mix, category strategies and pricing strategy to help drive both marketing efficiencies and margin improvements, with an increasing appetite to drive even more through this newly created capability. We're also commencing a project to replace our legacy order management system. This will give better stock availability and delivery options for customers and will deliver a step change in our customer experience. It's a major element in replacing our older mainframe-based systems. Within financial services, we're continuing to develop systems and processes to continue to meet regulatory requirements and do the right thing for our customers by lending responsibly and to manage our risk in light of the economic outlook. We've already implemented the financier account management and power curve credit decisioning systems and will continue to develop these, as well as implement a new tool which will give us real-time credit decisioning. This will significantly add to our customer application accept rates by using enhanced data sets and personalised customer journeys. Our focus still remains on building strong foundations, but more than ever to maintain our incredible value offer, we're taking a hard look at all of our costs to ensure we are efficient across the business, and where we identify savings, we'll be reinvesting in data and technology resource to future-proof the business further. We've already created around 50 new job opportunities, and with more and more talent being attracted to the studio growth story. These initiatives, along with those already implemented, continue our digital transformation and will build on the success we have seen to date and give long-term returns, so we reinforce our position as a leading digital value retailer. With that, I'll hand back to Phil to talk about the group's outlook.
Thank you, Paul. Turning now to the outlook and how we see the rest of the year panning out. The upturn in new infections, both on the continent and in parts of northern England, tell us that the pandemic is going to be around for some time, and its effects are likely to last for even longer. As you've heard from Paul, we think that Studio is well positioned to keep delivering great value to its customers. And fundamentally, our strategy hasn't been changed by the pandemic, unlike many other businesses. Our peak trading weeks are just around the corner, and it's still too early for us to give reliable guidance on the rest of the year. But what we have seen gives us plenty of confidence that Studio is capable of delivering a sustainable level of medium-term profit growth. Thank you for watching this presentation. Our Q&A session will begin at 9 AM today, but please feel free to give any of us a call with any follow-up questions.